Welcome to Crops, Cattle, and Charley. I'm Charley Martinez, and I'm joined today by Aaron Smith and the University of Tennessee Livestock Economist, Dr. Andrew Griffith, who is with the Department of Agricultural and Resource Economics. Today, Dr. Griffith is going to be discussing the boxed beef and fed cattle prices spread investigation report. So, Dr. Griffith, what were some of the highlights of that report?
Well, Charley, I think the report was somewhat disappointing when you'd expect something to come from it. I don't mean to sound cynical, but it pretty much stated things that we already knew, especially if you had kept up with the market and what was going on. But what essentially those that did the report, what they talked about is, when it comes to the Tyson fire and then COVID-19 is what the report was focusing on, and how the beef and fed cattle price spread widened so tremendously during both of those events. What essentially what they said was that supply and demand during both of those instances, when you look at the Holcomb fire, the Tyson facility fire, well, that was about 4 or 5% of total slaughter that facility was, and so they said that reduced supply. And at the same time, demand for beef was going up because that was during the Labor Day holiday purchasing season. And that's really what drove that spread. And that spread got as high as $67. And then they lead into a little further in their findings of, well, we increased Saturday slaughter to try to meet that demand. And that is exactly what happened. And of course, we ended up killing more cattle, just as many, if not a few more cattle, with that extra Saturday slaughter than what was happening before the plant fire. And so there's really, out of the Holcomb fire, nothing really that tremendous that came from this study. It was literally just analyzing the market. The same thing happened with the COVID-19. We hit a time period where we're fixing to go into the grilling season, and so demand would have been strong coming from March and April as these retailers and food services try to start purchasing product, and then all of a sudden we food services shut down, and so we have a huge demand for the grocery store retail outlet, and that spread ends up going as high as $279. But at the end, the findings were that there was no collusion among these packers to cause this. This was just all supply and demand fundamentals, which is what a lot of us folks had already said prior to this investigation.
So, Andrew, what can producers expect moving forward as it relates to this investigation?
There will be, there's going to be some more chatter, Aaron, on this subject, but at the end of the day, nothing's going to come of it. I'm sure there will be some legislative things where people are pushing for this, that, or the other, especially with some of these interest groups pushing dollars towards it. But at the end of the day, nothing was found in this report. Nothing else is going to be discovered to say that anybody was doing anything wrong. Whether they were or they weren't, it doesn't matter. I don't think they're going to find anything to say, hey, these companies were doing wrong. I think what it comes down to is these companies were taking advantage of the situation, just like the rest of us would. If you were offered the opportunity to buy something cheap and sell it for an extremely high price, you probably would do it to capitalize on the gain.
Awesome. Well, thank you for that insight, Dr. Griffith, and thank you to the viewer for joining us on this episode of Crops, Cattle, and Charley. We hope that you enjoyed it. We hope that you'll join us on the next one. Thank you.